Hello, Farm and Ranch Management. Pardon my helmet hair. My kids and I were just out harvesting free mulberries. So if there are mulberry trees in your neighborhood or out and about, they're ripe and they're ready. So that's your pro tip for the day. Today we're going to talk about the balance sheet. In general, it's actually, I think, a pretty straightforward chapter. I'm going to give you a few keys to unlocking the ratios at the end, what they mean, kind of how to interpret them. We don't have to memorize them, obviously, since everything is open book and open note. We don't memorize them in the big class either, but instead we have to understand an interpretation of them and how they can be used, because that's really what the purpose of the balance sheet is. So let's start off with unpacking some of the things about the balance sheet that you might see in an accounting class or a financial management class or a principles of finance course, and how we can apply them to a farm or a ranch. So first of all, the balance sheet is going to say XYZ Farm Company, and then it'll say balance sheet, and then it will have a specific date. So every day you could have a balance sheet, but you have to keep in mind that it could change every day. So June 15th, 2020. That's the balance sheet today. It's probably going to be nearly what the balance sheet is tomorrow, but if the values of anything on the balance sheet change, then this changes as well. And the sections of the balance sheet, we have current assets, non-current assets. These are listed off. We have total current assets, total non-current assets, and total total assets altogether. Then on the right side we have current liabilities, non-current liabilities, total liabilities, owner's equity, and then we have total liabilities and owner's equity. If it seems like this is already familiar, it should be, because this is simply just expanding on the accounting equation where we have that assets are equal to liabilities plus owner's equity, or if we do a tiny bit of algebra and say assets minus liabilities equal owner's equity, we're breaking this out into 5 different categories. Then we can do some analysis. So let's first look at current assets and non-current assets, and understanding current liabilities and non-current liabilities will follow very easily. A current asset is any asset that is cash, cash-like, or something that will be turned into cash. Typically we say that a current asset is something that is 1 year or less, and that comes probably from our liability section, where a current liability is a debt that's owed in 1 year or less. But the current asset section, yeah, that typically holds. But if we have grain inventory, we might not turn that into cash within the next 12 months. But the only purpose of having grain in storage is to sell it for cash. It's not an asset that we use to produce more. It simply is money or near money. Okay, so that's what goes in our current asset section. Our non-current assets is everything else. So land, buildings, equipment, those are all things that are non-current assets. So the line of demarcation is kind of 1 year. That, if you think back to principles of economics, short run and long run, the definition was in the long run something is fixed, in the short run, in the long run nothing is fixed, in the short run something is, but typically it's 1 year that divides the short run and the long run. Over here on my current liability and non-current liability section, again, it's 1 year. Current liability section is debts that are owed within 1 year. Oftentimes, this is the difference between accounts payable and notes payable. So current liabilities are going to be things like your line of credit or credit at any vendor that extends credit to you. Non-current liabilities are going to be things like equipment loans and real estate loans. If we take our total amount of assets and subtract our total of liabilities, we're left with owner's equity. Now, the owner's equity section can be broken down either on the balance sheet or in its own statement of owner's equity, where we see contributed owner's equity, or we see that owner's equity is increased because of appreciating asset values. But here it's really just that plug. It's the leftover after we liquidate our assets, pay off our liabilities, what's left to be yours. So really, we're just looking at a T account. We're putting all of our assets and all of our liabilities on it, and we're able to break this down and do more with it once we start looking at our different financial ratios. But before we look at our financial ratios, just a note on our different methods of valuing the things that we put on the balance sheet. So we have the cost method, the market method, and the lower of cost or market. And what's important is that we just simply understand what method is being used and what implications that may have. Now, there are some specific rules that go into this. If we're saying we're going to use the cost basis for our balance sheet, not everything is going to be listed at cost. For example, if we have grain inventory listed on our balance sheet, that's going to be listed likely at market. The same thing with market. We don't have a market value for everything. If you have prepaid expenses such as seed that is purchased, we can only put the price of seed has gone up. We're not going to address that. We're simply going to put the cost of the seed as opposed to some new market value. So it's important to remember that just because it's cost doesn't mean that everything on the balance sheet is listed at cost, or if just because it's market, not everything is listed at market. You can look at those specifics. The reason why I bring this up is the market method leaves more subjectivity to the valuation. So if a borrower is trying to convince a bank that they have a strong balance sheet, they likely will use the market method, specifically if they have land that has been owned for a very long time, whether or not there is a liability held against it in the form of a first mortgage. There is some subjectivity to that. The other reason why I bring it up is because there's one place in table 4-4. So it's on page 66 if you have the red textbook or thereabouts in the blue textbook. And this balance sheet for IM Farmer is good because it just has two columns for cost and market, and it shows what the balance sheet is under either scenario. In the market method section for liabilities, and we would think, well, why would liabilities have a difference between the cost and market method? We're not selling liabilities. And indeed, we have notes payable for machinery is $18,000 because that's what we owe on our equipment loan. And we have a real estate note for $177,500. Well, that's not going to change whether we're valuing our assets at cost or market. But then we have a little inclusion of non-current portion deferred taxes. $17,000 under the cost method and $74,000 under the market method. This is when you should pause me and see if you can look at the asset portion of the balance sheet and figure out where that's coming from. So I'll ask again. Look at, and I'll even help you out, look at the non-current asset section of the balance sheet, and that will give you a hint as to why that long-term or non-current liability is different. So pause me, come back in a second. Okay, you're back, and hopefully you have an answer. The answer is, if I'm using the market valuation method, when I value my land at $315,000 compared to $630,000, yeah, $630,000 might be actually a conservative estimate of the market value of your land. And you want to tell the banker, hey, look, I have this strong balance sheet. The market value of land is double what I paid for it. But to go along with that, if you're utilizing that valuation, there's a liability that's come along with it. If you sold the land or if it had to be liquidated, you would also owe income taxes on the gain or the appreciation of the asset. So that's why if you're going to value at market, you got to recognize that there's a liability that would go along with it as well. Now you might think, why would I ever do this at market? I don't want to have to pay that. Remember, you don't have to pay it. The only reason why you would have to pay it is if you sold the land that was attached to that liability. So we don't want to overinflate our net worth or show some stronger financial position than what we really have. Okay, so other than looking at what our net worth is, we're really interested in liquidity and solvency, which is our net worth, but breaking that down even more, and then changes over time. Okay, so changes over time will be in analyzing how our liquidity ratios and how our solvency ratios are changing. And our liquidity ratios are the ones that as managers, in the short term, you have probably more ability to make decisions and actually manipulate and change those ratios in your favor, or if in case they're causing issues. So the two liquidity ratios that are most important is A, the current ratio, and B, net working capital. And the current ratio is simply equal to current assets divided by current liabilities. Now, I like to think about these ratios from their range and extremes, whether they're bounded or unbounded, and then in the middle where they go from being good to bad. So my current ratio, we think about a fraction. What's the lowest this can be? Well, these are both positive numbers, so it can't be negative. Instead, it's bounded between 0 and infinity. Because if we have a whole bunch of cash and cash equivalents but no current debt, 10 divided by 0, or even if we have some current assets and no current liabilities, something divided by 0 is infinity. And the line of demarcation where we go from worrisome to less worrisome is 1. Now remember, this isn't saying if we're at 0.99 and then next year we get to 1.01, it's not as if we've magically changed our performance from bad to good. But there's something that happens at 1 that should make your brain say, oh, I get why this current ratio is important. Current assets are the things that we have that are cash or are meant to be turned into cash. Current liabilities are the debts that we owe within a year. It sure seems to me that we should have current assets that are greater than our current liabilities, our ability to make debt service payments. It's got to be over 1. If it's less than 1, we have problems. Now, this isn't the same for every industry. If you're interested in grain production, your current ratio probably needs to be higher than if you are in livestock production or if you are in dairy production. Because in those latter two industries, my revenue streams are more constant. I get payments more than once or twice per year. So we can have less cushion and still be able to operate. Net working capital is related to the current ratio. In fact, it uses, and sometimes this is called working capital, current assets minus current liabilities. Now remember, before I said your current ratio could be infinity. You have $10 and you have no current liabilities. You could say, hey, you could say to the banker, my current ratio is amazing. It's 1,000, 1,000,000, infinity. But you don't have anything. You have $10. Net working capital says, hey, take all of the things that you have that are cash and pay off all the things that are due soon. And what do you have left? The word capital is oftentimes confused in finance and economics. And really, if you wanted to hone in on this and really understand it, you'd call it net working financial capital, because it's how much financial investment do you have at your own exposure without liquidating things that aren't meant to be liquidated. We don't want to sell land to make other purchases. We don't want to sell breeding livestock to make other purchases. Instead, there's some investment opportunity to buy land. Well, if you liquidate your current assets, if you sell all the grain in the bin, if you cash out certificates of deposit, how much do you have? How much free cash is another term for net working capital do you have at your exposure? So this one kind of gives us do we have a problem going forward? This gives us a relative, or it gives us a number. Okay, my current ratio is 2. That's great. I've got $2 for every dollar, or $2 for every dollar of current debt. But how much do I have? If I wanted to, neighbors selling a section, or the neighbor selling a tiny 20 acres, can I liquidate enough money to buy 20 acres that I've always wanted? That's what net working capital tells us. Okay. Our solvency ratios are more about tracking things over time, but they're also about how we're utilizing equity and how we're utilizing debt. So we have 3 ratios: debt to assets, equity to assets, and debt to equity. And these are self-defining. You don't have to memorize these at all. Total liabilities divided by total assets. Total equity, or just equity, to total assets. Total debt to total equity. Okay? And let's just think about a range and then think about what's good and what's bad and what it's telling us. Total liabilities divided by total assets. This becomes a problem when this number is greater than 1. Okay? So it can be 0. It can't be less than 0 because we can't have negative liabilities or negative debt. So it could be 0, and you might think automatically that 0 is grand. We have no total liabilities. Might not be the case, but I certainly know that I want to have more total assets than total liabilities. So when this becomes greater than 1, that's saying you are insolvent. That is not the same thing as bankrupt. It is just saying you owe more than you own, and that certainly can happen. So 1 is our line of demarcation. If your assets have dwindled away and are worth nothing, I guess this can be up to infinity, but generally when the number is greater than 1, sound the alarm. Equity to assets. This is kind of saying what percentage of your stuff do you owe free and clear? If I have a farm that's worth $10 million and I have $10 million of equity, that means I have no debt. That means everything that's on the balance sheet is mine. I own it free and clear. There are no debts obligated against it. Again, Obviously, this total equity over total assets, 1 is the highest it can be. 0, it can be lower than 0 because our equity can be negative. But we're just looking at what percentage of your assets do you own? And this is another way to frame equity. Maybe our equity is going up, but we're expanding at a great rate, and it turns out that our percentage of ownership, or the amount that we owe that's really ours, is going down and down and down. So we can use that to see how the business is growing going forward. And finally, total debt to total equity. Now, total debt can be a positive number and total equity can be 0 or less, so it's not really bounded on the bottom. Not bounded on the top or the bottom. Instead, this is telling us if we have a ratio of 1, that's saying that my total debt is the same as my total equity. That my assets in that case would be twice as much as my total debt. Notice that these things are all kind of related to each other because they all have something to do with the accounting equation. This is asking, how are you using your equity to finance the business? And it really gets us really digs to the point of interest expense from an implicit standpoint. So if you own the farm and it's worth $10 million and you have no debt at all, your debt to equity ratio is 0. And that seems like that might be a good thing, but it might not as well. Say the farm isn't worth $10 million. Let's say it's worth $20 million. And it's spitting off $100,000 of income every year. 100 divided by 20. It's a lot of zeros. Is a horrible rate of return. So we could be taking that money and investing it and making a higher return and then borrow money instead. Okay, so one of the things that, and we can talk about it individually, we can talk about it in Zoom meetings. I want us to get, what do these mean and why do we care about them? It's so that we can compare firms that are different sizes. It's so that we can see how the firm is changing. But we also have to start thinking about utilizing debt financing, and why debt isn't always a 4-letter word. Notice I said it's not always a 4-letter word. Sometimes it is. So that's something that you need to think about. All right, there is an activity at the end of chapter 4 that perhaps would be good to look at. It gives you a balance sheet and some ratios and asks you to fill in the blanks. That would be a very good practice problem for you to do. Otherwise, I promise to keep these under 25 minutes, and we're at 23, so I'm going to sign off. We'll see you tomorrow.